Hello again. Let me add some remarks now on the treatment on interest and royalty revenue in the OECD Model Convention and naturally then also in most of the existing double taxation treaties. Well, first let's turn to interest income, and there we have basically the same dilemma as for dividend income, although with a bit less of complications, because if we were to give the right to tax this income to the state of source, then there might be problematic consequences. The only other alternative is to give it to the state of residence, and so here the people who established the system of the OECD Model Convention had to make a choice. Should it be the state of source which can tax interest or the state of residence? Well, what would have been our answer and what was their answer? Let's have a look to the nature of interest income. We can assume that if you give a credit to somebody and get interest in return, then this interest will always be the same percentage, the gross percentage, if the customers have the same ranking, so the same probability to go bankrupt, or to say it positively, the same probability that they can fully fulfill all their obligations under the contract, and that the loan is handed out in the same currency. Both is today no problem, also for a cross-border credit. So that means, what does it mean? If you give a loan of 100,000 to a customer in your home country, let's say Germany, and you get a gross interest then of 8%, so you get 8,000 gross return, and then you will probably get the same gross amount of 8% also when you give that loan to a comparable customer of comparable ranking in the same euro currency in the country of faraway-stan. Now we have 8% gross from both countries, so identical. And what happens now if taxes come into play? If we give the right to tax the interest to the country and only to the country of source, then we would end up with, from Germany, a net outcome of 6%, because 8% would be lowered by 25% tax, so 6 remain net. But if we give the credit to faraway-stan, we would again get 8% gross return minus the 10% local tax of faraway-stan, so that it's 7.2% net. The logical consequence would be all persons in the market would only give, so all Germans would like to give their loans only to business partners and customers from faraway-stan because of the tax difference. So German customers and German banks would get no credits, or they would have to pay a far higher gross rate. So the market in the inland would break down or would suffer considerable hardships, and that means this seems not to be a very viable solution. The double taxation treaties so must decide on for a different rule. You can't say that interest should be taxed in the source state. That doesn't seem to be so convincing, at least not in the present system. So we must think about the second alternative. That's the right to tax should go to the country of residence of the taxpayer who gets that interest income. So in that case, the situation would be the following for the investors. The net revenue would always be the same, not depending on where they give their credits to. Let's have a look. For example, if you are from Germany and your tax rate on interest is 25%, then if you give a credit to Germany, you get 8%. You have to pay 25% of that to the fisc. You keep 6% net income. If you give it to a faraway-stani customer, you get again the 8%. You have to pay again your German tax of 25%. You keep 6% net. For the investor from far away, the situation looks as follows. If he or she gives a credit to a German, he gets 8% gross, has to pay 10% home state tax, keeps 7.2% net income. If he or she gives a credit to a faraway Estonian customer, the same calculation, the same net outcome. So in that case, the rule would be relatively neutral to the market. We would see no immediate distortions. And so this rule is, under economic aspects, definitively preferable. And yeah, let's sum this up. The DTTs should give the right to tax interest to the state of residence of that taxpayer who receives the interest payment. Now, if the state of source also wants a bit of the revenue, that might be possible as long as it does not influence the overall tax burden. So as long as this tax can be fully credited to the state of resident tax, then it's just a matter of distribution of the money between the two participating states. So if we give additionally a right of taxation to the state of source, we should take care that this tax is limited in a way that the source state tax cannot create economic problems, so that in the end not the tax level of the source state becomes deciding for the investment. So in accordance with that, you find in the OECD Model Convention in Article 11 first a clarification that irrespective of what comes afterwards, the state of residence has always the right to tax. That's 11.1. That's just a clarification because that paragraph in this article is completely superfluous. Under the modern view of the system of a double taxation treaty, the Articles 6 to 21 only regulate which rights the source state has, if the source state can levy a tax or not, and it's generally understood that the state of residence always can tax the worldwide income. So 11.1 would not be necessary. However, it has an important function. It reminds these people who are used to my state gives the exemption method for everything. They remind these people, no, for this there will be no exemption method, because paragraph 11 begins with the reminder, irrespective of what comes later, it will be, or there will be, a right of taxation for the state of residence. Now, if the states agree that also the state of source can levy a tax, that will be mentioned afterwards, but there will be a limit. For this limit, the OECD proposes to set 10% as upper limit in 11.2. In practice, many states agree on lower levels, even often on 0%. If two states agree on a 0% taxation in the source state, then this is usually technically done by just leaving Article 11.2 of the OECD Model Convention away, so to leave it out, because then the article just says there is a taxation in the state of residence and gives no right to the source state, so the matter is by this way then clear. The economic character of Article 11 is again surprising. We see Article 11 gives the right to tax to the state of residence. The idea is then the taxation is completely neutral, so no distortions in the market. What, however, the writers of the OECD Model Convention did not see in the 1970s or 1960s when these ideas were developed is that nowadays, when everybody can set up foreign companies, foreign juridical persons, this gives the people a factual option. So, such a factual option means, in practice, you can freely choose where you want to pay your taxes if you behave in the right way. So, if you design or arrange the facts in the right way, how can that be done? Well, the only thing you need to do nowadays is You establish a juridical person in the company in that state where you want to pay, or where you want that the taxes for the interest should be paid. Then you transfer necessary capital as a contribution to that company, and that company then gives the credit to the intended business partner. Under these circumstances, the result will be that not you anymore, but the foreign juridical person is the recipient of the interest. That juridical person is not in your state of residence, but in some other state which you regarded as cheaper. And so, under these rules, you could basically freely choose where you want to have the taxes on huge amounts of interest to be paid. If, for example, you give a credit which generates annual interest income of 50 million euro or dollars, and you don't want to pay 25% at home, then it's a nice idea to say, okay, then we set up a company in a foreign state which has nearly no income or corporation tax. This company then gives the credit, so the interest is received by that foreign company, and under the system of the DTTs, then this interest would be taxed in that foreign country. So to illustrate this, we have the taxpayer, we have a contract partner who wants to take the loan. Now we don't want to pay interest in the high tax country, so we set up a foreign company in a low tax country. This gets the money. The credit is given by the foreign company, so the interest is now paid from the contract partner to the foreign company. Your home state receives nothing. Under the rules of paragraph 11 OECD Model Convention, now the interest has to be taxed in the foreign company's state. And if the taxpayer's home country ever sees some money, it depends on if the foreign company ever pays out dividends to the taxpayer, to its shareholder. Well, that's plain and easy. So the Article 11 has a nice basic idea. It seems to be neutral in the theoretical world, but if you go to practice, you see that's completely arbitrary. That can't stand or survive the test, the contact with reality. So, as this outcome was not exactly what the authors of the rules originally wanted to achieve, naturally later a multitude of countermeasures against such, let's call it, abusive behavior has been designed. For example, there is the so-called controlled foreign company taxation, where the national legislators in the taxpayer's country introduce a kind of extra tax on the shareholders of companies which do this tax saving model. Or sometimes interest payments were declared as non-deductible business expenses, so the person who takes part in such a scheme and takes the contract and pays the interest has disadvantages. Or last but not least, there is nowadays also in most DTTs the addition of that principal purpose test established by the multilateral instrument of the OECD, which nowadays says that the benefits of a treaty can be and should be denied if, for the involvement of a foreign company into a transaction, taxation is the major or at least one of the substantial motives, which would really be massive, because that says our case where we until now use that factual option, we just establish a foreign company that gives the credit, and now the interest payment goes to the foreign company, and let's say the source state is excluded from taxation under the rules. Well, that doesn't work anymore under such circumstances, because then the source state can just say, I deny the applicability of the treaty because this is a tax-saving model. So Article 11, what it says, plays no longer any role. I can levy my full amount of home state of my own taxes, and that's it. In the EU, these rules were sometimes implanted into EU law, but only in a reduced way. The so-called Interest and Royalty Directive of 2005 established the rule that interest payments made cross-border between two EU states remain free of withholding tax in the source country. So taxation only in the country of residence of the recipient. However, the scope of application of this directive is very, very restricted. It applies only to cross-border interest payments between companies of the same small core of a group, so only between parent and immediate subsidiary, or between two direct subsidiaries of a common parent, so direct sister companies. At a later date, the EU also became active with regard to these abusive models and obliged the member states to introduce the one or other measure against such tax saving models based on the interest article. For example, they were all called up to establish an interest barrier rules restricting the deductibility of interest as a business expense in cases which might be an important case of tax profits shifting to other states. And they also compelled the member states to establish a regime of controlled foreign companies taxation with regard to interest payments to low tax states. Yeah. Now, what about royalties? Royalties, first, the name means nothing else than license fees for the right to use a patent right or brand names or anything like that. There is an explicit explanation in Article 12, I believe it's paragraph 3 of the OECD Model Convention, what the term covers and what it does not cover. Here, the basic principle, which has been established some decades now already, is that royalties should only be taxed in the state of residence. Article 12.1. Now we should think a bit about why this principle has been established and why the source state taxation, which was allowed by elder versions of the OECD Model Convention, has been cut back and abolished more and more. In order to show that, it's best to see, or to have a look at an example calculation. Imagine we have developed a new medicine against some important disease, let's say cancer, death, empty bank account, or what disease ever. So we have had development costs of 1 billion euro. So in the German terminology, 1 milliard of euro. So much money. Now, due to the importance of our new medicine, everybody orders it from all over the world, and very quick we give license to produce this new medicine to factories all over the world. So after or during the first year when the medicine goes to the market, we get revenues of different kind. First, revenues from our own country, 20 million. The license fee from state A is 10 million, state B 70 million, state C 300 million. So altogether we earn 400 million in the first year. However, our costs were 1,000 million, so we still are in the loss zone. We are still 600 million below zero. Now, what would be the consequence if we allowed foreign countries to take a tax on the revenue, a kind of a withholding tax? In that case, the calculation changes now. We have in our own country, where we are properly assessed and can set off our costs against the revenue, 20 million. Then the tax from state, the money from state A, let's say the local tax rate is 10% only, 1 million taxes. State B, 70 million, let's say the tax rate were only 5%, then it's 3.5 million, 10% on 300 million, whatever you like. So we have a total tax paid of 34,500,000, although we are still within the loss zone. And that means if we allow to levy taxes to the source states from where license fees roll in, then it might be possible that in the end taxes are levied on the income, although there is still a loss and not yet a profit. However, in addition to that, the problem is graver than we have expected, because normally you would expect that taxes from the source state can be credited to the tax in the home state. Yes, indeed. These revenues or these income will be part of the total worldwide income, so the source state tax should be credited. But when you look to the tax in the state of residence of the taxpayer, we are still within the losses. So there is no tax, no positive tax burden on this income from abroad. So we cannot reduce our home state tax. The tax credit goes away without any effect. A zero tax levied by 34.5 million is still a zero tax. Tax saving effect of the credit is zero. And that means this foreign taxes on the foreign license fees which come in create a definitive extra tax burden in that situation. So kind of a double taxation for which there is never a relief, and that should be avoided. And that explains why Article 12, in an age of higher and higher importance of research and development, has developed to a form in which the source state gets no taxing right at all. This seems to be the most convenient solution. However, what we can see a bit with a bit of criticism is that the same principles are also extended to the taxation of license fees for brand names, business concepts, and things like that, because one can probably debate much about the question if investment in such marketing things also justify to apply this solution. I'm not sure if the money which you invest into developing a brand name really is so much of a progress for humankind then, or as the development of a new medicine which prevents death for at least 200 years. I don't know. Here we should ask a marketing expert. Probably he or she would explain to us it's exactly comparable. I don't know. But you see here that indeed, or at least the principle behind Article 12 has some reasonable background. Again, when we go to EU law, we can find out that the EU has a long time ago established in a directive a similar principle for some cases of cross-border license payments. It's again the so-called interest and royalty directive of the EU from 2003, I believe, in force since 2005. And it says the taxation of license fees in the source country is forbidden. So establishes the same principle as Article 12 OECD Model Convention. However, as you already know, this interest and royalty directive only applies to very rare cases. First, only license fee payments cross-border from one EU state to the other. And second, only license fee payments between members of the core of a group. That means either from an EU subsidiary to an EU parent company, or the other way around, or from the subsidiary of one parent to a subsidiary of the same parent, so between sister companies. Somebody told me some years ago, originally that had been planned as a kind of an entrance into a wider solution originally one intended to lower down the participation thresholds more and more until in the long run, shortly before the beginning of eternity, one intended then to drop them completely, so that in the final effect the solution of the OECD Model Convention would have become a binding EU law, so that would have been enshrined and ensured for all EU states, at least in the contact with each other. But this development was stopped after the directive entered into force. Evidently, the Council and the ministers lost their interest in developing that initial solution further, so there was no progress there. So we have only that beginning of a solution here, that very isolated solution. One of the reasons for not extending the directive scope was probably its effects already for tax saving, because when you have a look at the Article 12, and necessarily that also happens then where the same principle is in EU law, when you look to Article 12, you see again it contains a factual option, because if Article 12 says license fees are only taxed in the country of the resident, of the taxpayer who gets that money, then the easiest trick in the world is it to establish a subsidiary as this taxpayer and place it in whatever state you want, which has a very low tax level. So if you live in Germany, the easiest way how you can avoid a high German tax on license fees basically is you just decide, I don't get these license fees myself. I set up a corporation in a foreign country. I look for some advice which foreign country with the DTT is the cheapest one available and the securest one. No civil wars, no revolutions, no confiscation of business property expectable in the next 50 or 100 years. So plain and simple, that's my country. So I set up a corporation there, it gets a patent right, and in the future it will collect the license fees. And then Article 12 says these license fees are not taxed in Germany where I live, but in the small and low tax country which I chose by establishing a corporation there. So Article 12, like Article 11, contains a factual option for the taxpayer. This could not be really foreseen in the 1960s or 1970s when these principles were developed, because at that time it was not so frequent and not so easy to establish a corporation as a subsidiary in a foreign country. That was difficult and not completely liberalized. So it was not present within the people's imagination. Nowadays, everybody knows about it. The trick is very easy. And so naturally, as the trick is so easy, and as it was not what was originally designed or wanted, naturally the fiscal authorities thought about creating countermeasures. There is a mass of them. For example, some years ago, some states like Germany introduced a license barrier, which sometimes says part or all of the license payments which go to a kind of a tax saving model are no longer deductible business expenses. That hurts the contract partner who pays the license fee, especially when that or if that contracting partner is a member of the own group. It creates enough influence to probably be an argument against such a tax saving model. Furthermore, within that controlled foreign company taxation scheme, it is customary that when you are the shareholder of a company in a low tax state, and this company in a low tax state in turn receives dividends from license fees from wherever, then you will be subjected, you as a shareholder, to an additional tax just because you own shares in a company which receives license fees in a low tax country. And this additional tax is usually designed in a way that every profit or favorable effect from shifting these license fees into the foreign company is completely destroyed. Furthermore, recently in most of the double taxation treaties existing was introduced that already several times mentioned principal purpose test, PPT, which says plain and simply the benefits of a treaty can be completely denied to any corporation where there is the justified suspicion that this corporation has been introduced or involved in the transaction, mainly for tax purposes. And that is here the case. You sold a patent right to a subsidiary corporation which you set up yourself recently. That maneuver only makes sense, or mainly makes sense, or one of the main motives must be to save taxes, to bring the royalties out of scope of the taxation in your country of residence, and that justifies that the state where the license fees come from can say we completely deny the application of the treaty to the license fees, so we take our full limited tax liability taxes on the license fees which go to the foreign country, and that usually will spoil the tax saving effects here. Yeah. EU law again followed this tendency, and so you find also recently some directive rules in EU law on such countermeasures to prevent tax saving models with license fees. Namely, if a foreign state makes itself attractive for such tax saving models just by creating a special low tax rate only for license fees, then this can in certain cases be attacked by the European Union as a forbidden state aid in the field of taxation. So that the foreign state can be forced to levy higher taxes retroactively. However, that can only work if that low tax corporation is within the EU. Nevertheless, where it applies, it's a high financial risk for the enterprises involved. Then the EU also imposed the obligation to create a CFC, so controlled foreign companies regime, to constellations like these, where license fees go to a company in a low tax area, so that these effects must be spoiled by the country of residence under certain conditions. And in addition to that, the Anti-Tax Avoidance Directive of 2016, the so-called ATAD, also contains an obligation that all member states must, within their corporation tax legislation, create a so-called GAR, a General Anti-Abuse Rule, which always allows the fisc to deny the favorable consequences of tax rules in cases where the transaction is plainly seen artificial and is not motivated by economic motives, but only or mainly motivated by the wish to save taxes. So yeah, these are the rules mainly for interest and royalties. And well, this is again a reason to make a small chapter break and to finish this video and then wait for the next one. Have a good evening, or have a good lunchtime, or good breakfast whenever you saw this video. I thank you for watching. Hope you survived it in good mood, and would like to see you again soon. Thanks and goodbye.